All right. Good evening, everyone. Very nice to see you all here this evening. Really looking forward to this evening's web class because it is a timely topic with everything going on in the marketplace right now. There is no better subject to cover than the red flags of underwriting. And that's why we have brought in the man, the legend, Paul Hopkins, to walk us through that this evening with myself. So before we get running, just a couple of quick housekeeping items. Number one, we have opened up the chats, but we will be doing Q&A at the end. So if you do have a question, please don't put it in the chat because it just gets lost. There is a Q&A box right on the bottom. Click Q&A, put your question in there. I promise we won't leave without answering your question. It just helps us stay organized. So put all your Q&A in the Q&A box. But as we get revved up, I'm curious, where is everybody tuning in from? It's always nice to see all the different cities we got covered. So put that in the chat. Where are you located right now? Let me know. Oh, we got Vancouver, Elmira, New York, Ancaster, Winnipeg, Mississauga, Fort Myers, all over the places. New Jersey, Burnaby, Toronto, Ottawa, Toronto. So we got a couple Torontos. There's way more people on here. Come on, put it in the chat. Let me know where you are. Toronto again. That's awesome. So we've got, it looks like we've got both coasts covered and a whole bunch of different countries as well. Atlanta, that's awesome. Colchester, Montreal. Excellent. So without further ado, let's bring Paul on board. But actually, Paul, I think before we get started, I think we should just say a big congrats to August and Ava, our partners in all of this kind of stuff. They just welcomed their son today. So big congrats to August and Ava on the birth of little Atlas.
Yes, absolutely. A big day indeed. So congratulations to them.
All right. So Paul, take it away. I leave this in your capable hands. But again, if you do have a question, put it in the Q&A box and we'll make sure we get you covered at the end.
Just one thing, if you could allow me to share. And
all right, you are good to go.
Excellent. Okay. All right, everybody see my screen? Just want to make sure I'm
we are good to go here. Yeah,
okay.
We can see it just fine.
Perfect. Okay, everybody. Thanks for tuning in with us today. And again, my name is Paul Hopkins with CPI Capital. I'm the acquisition director with CPI. And today we're going to cover about pitfalls, unveiling pitfalls, a guide to recognizing red flags in multifamily acquisition. So this could be a very dry topic. I tried to make it as fun as possible for everybody here. But please do, feel free to ask questions and engage with me while I'm giving this presentation. There's a lot to uncover when you are doing underwriting on a multifamily deal, and when you're looking at acquisitions on a multifamily deal. And so there could be a lot that comes up. Just a lot of problems that might need to be solved. But do keep in mind that when you do see a red flag, it just means, something that you need to look into further. It could be an opportunity, or it could be a chance or like something that is so bad that you just got to walk away. But, where there's chaos, there's opportunities. So keep that in mind as I kind of go through this, that, you're always going to have problems. It's just, how do we deal with it and how do we solve it? So, we put this presentation together for you if you're new to real estate investing, or if you're looking to expand into new markets. I did a webinar not too long ago about market selection. Highly recommend going back and checking that out. We want to help you make informed decisions. If you want to make more, raise more capital for your next deal, or if you're a passive investor who wants to make better investment decisions. And again, today it's Seth and myself, and who we are. CPI Capital. We're a real estate investment firm that specializes in U.S. multifamily assets. We're regionally looking around the Sunbelt states, but we're hyper focused in on Tampa and Jacksonville. We have a total of 936 units, for a total of 208 million assets under management. So we offer investment opportunities for both Canadians and Americans. And of course, if you're interested in passive investing or co-GP opportunities, feel free to book a call. This is the link to go ahead and book a call with us and to get going. So what we're going to cover today, just 3 items. Keep it pretty simple. We're going to go over what is underwriting. And I'm going to explain a little bit about underwriting initially, and then the holistic evaluation. And then we're going to get into the underwriting red flags. So like, let me just see if I could pull up, just make sure. Yep. Okay. Seth posted that in the chat there. Perfect. Perfect. Okay. And is there any Q&A? So Seth, just keep me honest as we're going along. If there are any questions that pop up in the Q&A that I don't see, just feel free to stop me and we'll carry on.
I'm on it. We'll just handle all the Q&A at the end, and
Okay.
And that way we won't miss anybody, and we can go through it one by one.
All right, you're the man. Thank you. Okay, so on to the next slide here. Oh, before I get into that, so I also want to know. So everybody posted in the chat group, you know, what where they were all from, but I'm curious to know like what everybody's experience level is in this group. Are you an active investor, passive investor? Have you underwritten deals before? Multifamily, single family? Just throw it in the chat. I'm just curious to see what everybody's experience is within here. But as I go, I'm going to talk a little bit about you know, the multifamily underwriting essentials. Oops. Here we go. So here's the definition of underwriting. So in the realm of finance and underwriting, underwriting spans various economic sectors, including finance, markets, real estate, and personal banking. So it originated as a method where a financial institution assumed risk on behalf of another entity for a fee. Basically, like a bank is assuming a risk by giving you a mortgage and charging you interest as for their fee. And underwriting has evolved into this very meticulous data-driven evaluation process. And you got to acknowledge all the potential inherent risks that come along with it. So let's see, just going back to the chat here, we got people that are new to multifamily, mostly passive, but wanting to get into multifamily. We've got another underwriter in here, active. Okay, perfect. Got a lot of experience, it looks like, so far in here. Great. Here we go. So in multifamily underwriting, the focus is on collecting data and making informed assumptions regarding the property's future potential. Multifamily underwriters, such as myself, we analyze the risk and reward associated with a potential acquisition. Underwriters tasked with making assumptions grounded in available data, project the future cash flows to determine property value based on return metrics and risk considerations. And that's pretty much it. So in a nutshell, multifamily underwriting entails a meticulous assessment of data, risk, and future potential to make informed decisions regarding a property's acquisition. That's a lot in a nutshell, actually. So let's dive a little bit more into the underwriting. So I've basically summarized underwriting in 7 steps, and I'll share them with you here. So you want to determine the in-place revenue using your rent roll to determine the in-place rents that the property is collecting. You've also got other fees and laundry, pet income, RUBS, utility billing. These are all items that bring revenue to the property. You want to determine your operating expenses. So like these are expenses that are needed to run the property. So like marketing or payroll, real estate taxes, just to name a few. Then you want to model your business plan. Are you doing renovations? And are the renovations going to increase rents? Are you going to start, say, valet trash in 6 months? You need to accurately model your business plan in a spreadsheet. And then the next one is capital expenditures, also known as CapEx. This is your rehab construction budget. And this is, getting the budget right is pretty critical. And you also want to know are you raising equity for that CapEx, or are you going to a bank and getting financing for that construction cost? You want to model in growth rates and other assumptions. Year over year inflation, what's the physical and economic vacancies of the property. You got to put those within your model as well. And then next is the debt and equity evaluation. So looking at different loan products that are out there. Are you going to use a bridge loan? Are you going to use bank financing? Are you going to go to the institutions? Which loan product is best suited for you? Floating rate, fixed rates, more leveraged. And so there's a lot of options that are out there, and it's important to choose the right option for you. And then determine the valuation. What's your exit value as far as the exit cap, the cap rate of the market, and that will help you determine what your purchase price is going to be. So that's underwriting summarized in basically 7 different steps. So is it that easy? Does the underwriting process simply end by reviewing financials and crunching the numbers? Well, if you're a data geek like me, and this guy here that he's one of these guys that sit behind the computer screen and looking at spreadsheets all day, there's a little bit more to it than that. You need to go deeper and to find out what other deep layers of that you might uncover with the property or in the market. What are ways to future-proof your underwriting strategies? And so we need to get a little bit more knowledgeable about what's going on. So what I like to call it, the holistic evaluation in multifamily property underwriting. So when you're investing in multifamily property, it requires a comprehensive approach that goes just beyond the mere financial assessments. So, while you're examining profit and loss statements from brokers and sellers, it is essential. You need to know how that property's performed in the past. But it's also important to know what the other factors that are shaping the real estate landscape for this property in particular. And so like the holistic evaluation, recognizing that financial trends are just one part of the puzzle. So I've broken it down into basically the 4 key pillars of holistic evaluation. There's financial trends. So obviously the financial trends provide insight to the property's past performance, but it unveils a richer narrative. The next pillar is the quality of tenant populations. Tenants define the heartbeat of the property. They are what exist, they are what is driving real estate. Real estate exists for people. Keep that in mind. Real estate exists for people. If your people are moving to another location, population growth and job growth, follow those trends. But real estate exists for people. So our evaluation needs to extend out to the people who call it home, assessing their quality, the needs, and the stability which they bring to the investment of the property. The next one is competitive analysis or a property condition. So competition isn't just about your comparable properties. It's about anticipating your trends, looking at shifts in the economy, and positioning yourself to be strategic in the market landscape. And finally, market dynamics. Understanding a broader market dynamic is imperative, and how we explore these external forces that shape the opportunity or create different challenges that could impact the property's performance. So in a recent webinar, I actually broke down the market selection I broke the key pillars down into actually what I called essential factors. So if you go back here, I have the 4 key pillars here, but I broke it down even further into 6 essential factors, talking about population growth, the median household income and growth, the median house and condo values, rent growth, a change in crime, and job growth. So these are, the 6 essential factors when you're selecting a market. And if you select a market based on the essential factors that I gave you in that webinar, then a lot of the hard work is done as far as market selection and the right property in the right location for the right tenant. So that's a lot of the hard part. So go back, look at that webinar on market selection, hone in on where you need to be looking at, and that will take a lot of the other kind of questions or answer a lot of the questions for you. So why holistic matters? So real estate, again, is local and it exists for people, which creates a dynamic evaluation. So in an ever-evolving real estate environment, success hinges on the ability to see beyond just the balance sheets. So I'm going to unravel, some of the the intricacies of multifamily property acquisition, where the financial acumen meets a broader understanding of market dynamics, competition nuances, and the profound impact of tenant quality. So doing all of that, you'll ensure that your investments are basically as bulletproof as possible, and not just financially sound, but strategically resilient. So we cover a lot of these items in our weekly newsletter that is sent out to everybody within our database. So, there's lots of, current topics that are going on in the market. Market dynamics. We talk about some financial trends that are happening with the market. So be sure to subscribe to our newsletter on our website. Just go to our website, cpicapital.ca, and you'll see a link there to subscribe to our newsletter. Also, our CIO, August Benias, writes extensively about this in different articles and various topics on LinkedIn. So be sure to check him out as well, where you can stay up to date on a lot of these shifts that are happening. But here I'm going to start kind of diving into underwriting red flags against these 4 different pillars. And these are the top ones that I could identify. They're not all the red flags. There's definitely ones that kind of come up for each property. Each property is different. It has a different set of rules, locations, dynamics, but we can pretty much categorize them in these 4 key pillars of financial trends, quality tenant, property condition, and market dynamics. So I'm going to start to dive into a few of these with you guys right now, and these are kind of my top ones. Some that I've seen over the years. I've been underwriting multifamily properties since 2015 now, and so seen a lot. And so this is just a summary of some of my experience. So we'll start off with financial trends. So probably the biggest one when you're looking at the financials of a property is the declining trailing 12-month profit and loss. So when you start to see this downward trend in the trailing 12-month profit and loss statement, it's indicating that obviously you've got potentially declining rents. So you got to be aware of, brokers that may boost a perceived or higher value based on certain market rents. But if the trend is actually going negative, that's definitely a red flag that you want to pay attention to. So I put in here an example. This is taken right from a property. We input the profit and loss statement into our underwriting spreadsheet. This line item right here, net rental income from August of 2022 until July of 2023. And you could see that there's a steady decline between the months. Jumps up to 138, down to 125, 118, 16, 23, and it's going down and down and down. Well, that's a red flag. Why is it doing that? Like why is this property starting to lose revenue? Of course, this should be a no-brainer, but you want to make sure that you get accurate and up-to-date financials. As you're digging into the financials, sometimes you'll see like a T12 from last year, or it could just be like 6 months old. But you always want to get the most up-to-date information. You want to see what the story is, on the property that's happening right today. So you understand the true financial health of the property. So how I do it is I'm comparing basically the T12 against the rent roll, and making sure that the rent roll is saying how much income we are receiving in that month, and comparing it to the T12, making sure that they match. If they don't, then start asking questions why. So in getting up-to-date rent roll information is going to tell a really good story. And sometimes you may not be able to get a lot of that information, depending on the size of the property, depending on who the seller is. It could be a mom and pop seller versus a sophisticated seller that definitely has all their ducks in a row. So like I said before, if you're not getting the right information, doesn't mean that it's a showstopper. It's just you need to start digging in more, and could be an opportunity. Unrealistic projections or an overly aggressive assumption. So red flag. If you're looking at the offering memorandums from the broker, they may have like financial projections that rent growth is super high for the next couple of years, when in fact that the market isn't so hot as it used to be, or other items, basically like expense growth, like taxes, for example, understanding how your taxes are reassessed and adjusted on an annual basis. So unrealistic projections will definitely result in inaccurate return expectations. So you want to make sure that you're looking at all of these and able to meet within your model your debt service obligations and investor returns. So you got to use sources like CoStar or Real Pages, Axiometrics to gather comprehensive data. Compare the two; they're different. It's just one group has a different way of determining what these rent growth projections are in these different markets. And for example, I've got here a graph from CoStar for Tampa. It shows, in the first quarter, 2 quarters within 2024, there's negative rent growth. And we recently looked at an offering memorandum where the broker was projecting a 5% rent growth in year 1. Well, that might be true here in 2025, but not 2024. So you got to look at the resources that are available to you as well. All right, so we covered the first pillar. Now we're going into the second pillar of the quality of tenant. So looking at making sure that the quality of tenant and misleading occupancy improvements. So one of the biggest red flags is the seller could be placing unqualified tenants into the property to artificially boost the occupancy. If they've, like that previous example that I showed before, where they had trending revenue that was trending down, and the seller was like, "Hey, I'm going to be selling this property. I need to get the rents back up. I need to bring revenue back up. I need to bring occupancy back up." And he's just putting bodies in beds. He's not qualifying them or anything like that. And that can create some financial harm or stress that you don't need to deal with later. So you're going to be dealing with evictions or other social issues that come up when you're taking over a property. So it's important also to go through the making sure that there's tenant qualifications and the required background checks. You're not going to be able to get that information, or you might be able to, depending on the broker and how well they're willing to work with you. But to get that information, when you're first looking at a property, might be a little bit more difficult, but you definitely want to start looking into that once you go under contract and you're in your due diligence, doing your own independent screening, a lease audit on all these tenants, just to make sure that they're qualified and not just some random random tenant that isn't qualified to stay at that property. You could also run an affordability test, just seeing what the properties, where it's located, looking up the median household income, and looking at your in-place rents. So, for example, that I've shown here, the property that we were looking at, that 1 mile median household income was about $52,000. And the in-place rents was $1,400. Well, it works. It meets the affordability for that specific market within a 1 mile radius. However, the pro formas that were listed in the offering memorandum, it goes beyond what is affordable in that area. So so it's not just the quality of tenant, it's just making sure that also that tenant had the business plan matches the tenant demographics. Looking for excessive tenant turnover. So frequent turnover of tenants indicates a potential dissatisfaction with the property or the management. Well, that could be a good thing and a bad thing. A good thing for you that you can take over the property, kick off that property management company, bring in your own property management company, and turn the place around and work on that retention. But just that is a red flag to look out for if, because high turnover will increase to obviously more vacancy periods and higher marketing costs, and it will negatively impact your cash flow. So one of the things that we actually do when we underwrite is we input the rent roll along with the lease start date, the lease end date, and the move-in date, and built the spreadsheet. So like when we enter in all those dates, we're able to see how long all the tenants have actually been there for. And I've got two properties here that I'm comparing side by side. So one is a 251 unit in Tampa that we looked at, and the other one is a 138 unit in Jacksonville. And you could see the differences between the two, where the property on the left in Tampa, on the surface, it looks like it has better tenant retention. You've got a good mix of tenants that have stayed there. You've got 141 units that have stayed there for at least over a year. And you've got some tenants that have been there for 10 to 15 years. Where if you compare it to the property on the right, 77 or 55% of the tenants are still within the first year. Does that mean that all of them are going to leave within that first year? No, but they're brand new to that property. They haven't been there that long. You can see here that there hasn't been any tenants that have stayed there longer than 10 years. Just a few that have been there for 5 to 10 years. So, that is that a history of that property? Is it a history of turnover or the actual location? So those are starting the things that you want to start asking yourself. High vacancy rates. So a red flag, consistent high vacancy rates or sudden increase in vacancies can indicate issues with the property management, the market saturation, or other just undesirable living conditions. So the elevated vacancies, they may impact obviously the rental income and overall property performance, which will affect your investment returns. So here's an example. It's a 140 unit property in Jacksonville that we looked at. This is basically at the top of our profit and loss analysis. spreadsheet, we could see here how, basically the overall performance of the property over the last 12 months. And this one came with a lot of hair on the bone here. So you can see that the vacancy started off at 5%, and it just got worse. And then boom, like there went from 20 to 33 in just a very short period. Wow. Like, you got to ask yourself, like, what happened here? Like, tell me the story. Try to figure that out. And what we actually uncovered with this property. I'm actually going to get into that here in a minute as to like what happened with that. So that brings up basically another red flag, an over-reliance on a single tenant or an income source. So heavy reliance on a single tenant or income source posing a risk for tenant vacancies. So losing a major tenant can lead to substantial income reduction, again, affecting your property's financial stability. So an example of this, military bases are a great example. They're all over the United States. A lot of cities are based on the military base, and there's a lot of services that are around there to support that. But you also want to know if your property has a certain percentage of military. And there are, if you go over a certain threshold, Fannie and Freddie have limitations on what that may be. Are you also in a boom bust market or an oil and mining production location? Because the price of oil goes down and production stops, and then everybody moves away. So you got to keep that in mind as to where you're located, or government legislation. So let me explain like what happened here with this property. As you can see here, it was getting worse over time, but then what happened here in May was a big jump, and this property is located in Jacksonville. And what happened was in May, the Florida governor signed an immigration bill, which actually created a mass exodus of a single demographic that, it's a single demographic that potentially were illegal immigrants in this property. And so there was a mass exodus. Lots of people left. So that's what happened with this property. But that also brings up another red flag. You want to make sure that when you're screening your tenants, that they do have, they're legal citizens. They have an income, and they're allowed to be there. Now that could also keep in mind, like they may have families or someone that that had to leave, and they left with them for whatever reason. But just keep that in mind of relying on a single tenant in a single location. So you want to have a good, diverse tenant mix as well. Inadequate due diligence documentation. So this is when you start to get more into, when you're under contract and getting more into the property financials, and making sure that you're receiving all the documents that you need, any inspection reports, financial statements, also tenant lease agreements. So insufficient information will hide potential issues, making it challenging. So again, like this max exodus that happened, it could have been prevented with with proper tenant screening. All right, so now I'm going to get into the third pillar of property condition and some of the red flags that I see. So deferred maintenance, obviously visible signs of deferred maintenance or structural issues or a history of inadequate property keep up will result in higher and low, or even looking for higher and lower repairs and maintenance or turnover expenses. This will lead to significant repairs, can lead to unexpected expenses that will definitely affect your budget and reduce the property value. So a lot can be said just by looking at the outside of a property and how it's been cared for and maintained. Is the pool green? How long has it been green for? What's the roof condition there that you see in foundation cracks? Looking at the landscaping, if they're not taking care of the landscaping, well then, there's other things that they're definitely not taking care of. What's the condition of the parking lot? Are the potholes? Are there, just cars on blocks, for example? Those are the things that kind of just should stand out to you when you're looking at it. And then you got to understand your typical expenses and expense per unit in the market that you're looking at. And so, for example, Tampa and Jacksonville, when we're looking at the property financial statements, we want to see that the repairs and maintenance is somewhere between $370 to $450 a unit. Turnover should be around 250. And then you want to have some replacement reserves also factored in. The replacement reserves are items that need to be focused on it as far as maintaining to maintain your debt obligations as well. So, looking back at the financials, does the seller have a line item for repairs and maintenance? What is it? What is it per unit? Turnover costs. What are they spending on turnover costs? Or are they just a slumlord that's just sticking the next body in there and not doing any repairs and maintenance on that property? So those are things that you want to definitely keep a mind on. Legal and compliance issues. So this can definitely add up to some headaches along the way. So I'll show you some key ones to look out for. So if there's pending or any unresolved legal issues or compliance concerns, easements or different zoning problems, and they can lead to definitely some challenges. And because once you buy the property, you're inheriting those problems, and you got to clean up those issues. So let me give you an example. So this is a property that we were looking at in Jacksonville, Creekwood Club. And I highlighted it right here. This little parcel that's right there, it was separate from the purchase of the property, Creekwood Club. Not such a big deal, but we noticed also that the access into that separate parcel and separate property that was completely owned separately, it was using basically the same easement as the main entrance to this property. So that was definitely a red flag for us, and we had to dig into it a little bit more. And is there an easement in place? Was there an agreement from the seller and the property owner that allows them to access this location? They had stored RVs and other equipment back in this lot, and they needed to access it somehow. So that was definitely a red flag that we needed to be like, okay, well, we need to uncover this a little bit more. In the end, that one could have been an opportunity for us to actually buy that land from the owner of that specific owner, and actually do some more property improvements, more amenities in that space, for example. But that was just an example of what you can uncover just even doing this, doing a Google view of the property and driving around and asking these questions. Environmental hazards or contamination. So the presence of environmental hazards, flood zones is probably the most common one, or other contaminations such as asbestos, lead paint, or soil pollution. And I put in here fuel tanks because I've actually dealt with this before. The cleanup costs and legal liabilities associated with any environmental issues will definitely significantly impact the property's value. Because once you buy that property, now you're responsible for cleaning up that soil. So this is a very basic illustration, but it highlights a really good point. So groundwater always flows downhill, right? So just kind of look at This doesn't apply so much in Tampa because there's it's pretty flat. But for Colorado, for example, lots of rolling hills and things like that. And where are your properties located in relation to, say, a gas station? So is your property just downhill of a gas station? Well, guess what? Now you got storm water and underground water that is transferring underneath this gas station, and now it's coming into your property. Well, who's responsible for that soil cleanup if there is any kind of spill or contamination that happens? Well, in most cases, it's your responsibility. So, when you look at the geography of a property and where is it situated? Is it downhill of a sewer treatment plant or of a gas station, or other concerns? Is it near emissions of some kind? Just keep that in mind for sure. So more commonly is flood zones. So this is a property in Tampa that we were looking at. It's called Gateway on 4th. That was in a pretty well-known flood zone here. So you could actually go to FEMA, and I've put the link to where to go here, and it will pull up this report for you here. And so you can see that property is definitely within a flood zone. And that's, you got to, once you see that, then obviously you got to start asking questions about insurance. Does your insurance provider know that this is in a flood zone and where the location is? So a good insurance broker will definitely point these things out to you, and how to potentially mitigate or prepare for these issues that come up. But that is a red flag that you need to be aware of. Okay, so now I'm going into the final pillar of market dynamics, and the red flags that we're seeing in our underwriting. So this is probably our biggest kind of red flag at the moment. We're monitoring it and seeing how it affects the markets that we're looking at. But an oversaturation of new developments will draw tenants away from a certain class to the new class. So if you got brand new apartments that are being developed right and around a property, say you're looking at a B class property, and you got these brand new buildings that are coming up, what are they going to be renting them for? Because they're going to definitely be attracting a lot of your own tenants. And so they're going to be offering different concessions, things like that. And so they're drawing the tenants away from your property. And right now there's a record number of deliveries that are coming to the market in Jacksonville and Tampa. And so, want to know where these developments are happening and how they're affecting rents in the markets that you're looking at and in the locations that you're interested in. So you've got new increased competition from the new developments, and the tenant migration. They can move over to these different properties, leading to higher vacancies and reducing your rental income. So like an example here, Berkadia. Berkadia is a great source. Other broker firms have very similar type of reports, but this one here shows that this was Q1 of 2023, but they were showing that there's 204 units that are currently in the lease up phase. There was a total of 827 that are under construction, and then 2,000 are planned. And then you've got another 4,000 that are in concept. So, this is Central Pinellas that is in Tampa. And there's quite a bit of activity going on in just this area. And so what does that do? And what I was mentioning earlier, the blue bars here are the net delivery. So this is a report from CoStar for that same sub market, and you can see that there's new developments like coming in, and then it's tapering back off. And then the absorption, the rate at which these properties get filled up with tenants, you can see that the absorption goes up and comes back down. Well, what is that doing to the vacancy? Well, you can see that the vacancy is shooting up, but then it levels off. So, this is a good example of what these new developments are doing to your properties. And then I think this is one of the final ones here, the lack of market demand for the property type. So, if there's a limited demand for the specific type of multifamily property, or that the unit mix is not favorable. Say you've got a property that's just like all 1 bedrooms. Well, it's not a very good diversification. If you've got tenants that are more like families, they're not going to want 1 bedrooms. So, you got to understand the tenants and the tenant demographics, and what are they looking for. So you got an oversupply or a mismatch with market demand can definitely lead to difficulties leasing these units and achieving your rents. Again, going back to the webinar that I did a way back about market selection, the essential factor number 1 was population growth. Know where the population is going to. Where is the demand? And once you understand where the demand is, then that's when you start to focus in on that location. High crime. This is definitely a big one that needs to be watched out for. Elevated crimes in different neighborhoods can create a safety concern and could push tenants away, or it could attract the wrong type of tenant. And then it also leads to difficulty attracting the right tenant, retaining the tenants that are already there. And it also has impacts to insurance costs. It might be harder to get insurance. Maybe you can't get insurance because of the crime in that area. And I did talk about this in that webinar, the essential factor number 5, crime. And so here's some different resources for everybody that you could look up. So citydata.com, realpage.com, bestplaces.net, Justice Map, and great schools. So education is a direct relationship to the crime. So the higher the crime, the lower the education in the area. So if you got higher education, you're going to effectively have less crime. So taking a look at that and looking at what the school districts are looking like in your education levels. And then again, significant economic downturn. This is obviously one of the biggest red flags when you have the total economic market that you're looking at. If there's a significant downturn, not much that you could do about that one property in that one location, because all the properties around there are going to have a difficulty with leasing these units up. So you want to pay attention to what's going on in your own market, and because it will definitely affect your occupancy rates and overall financial performance of your property. So again, how do you know what areas are staying away and pretty stable in the economy? Well, again, go back to my webinar. I talked about it. Essential factor number 6, job growth. You got to make sure that there's a good, diverse mix of jobs. Ideally, there's 2 to 3% job growth over the last 12 months. You could go to this link right here, or the Bureau of Labor and Statistics, but focus on the last year and make sure that there's a job percentage change year over year. And Tampa, for example, is at 3.2. So really good growth in around Tampa. So that is it. Hopefully I didn't go too boring on everybody. And a geek in the spreadsheets like myself, There's a lot to cover. And I didn't want to bore everybody here with diving into spreadsheets. So like hopefully my holistic overview of underwriting was helpful for everybody.
Yeah, well, Paul, when you have profitable investments, the underwriting isn't so boring because that's what makes it happen.
That's right.
So, so that's awesome. We do have a bunch of questions here.
Okay.
So let's just go through these and make sure we answer everybody's questions. So a couple people have asked or messaged as we were going about recordings. We do these live, so we don't have a portal as of yet that hosts all the past recordings there. That may be something we do in the future, but we just want to make these available, for people live so we can do the Q&A. So as of right now, we don't have a recording section where you can go. Marcos,
we'll just have to do it again.
Yeah, we'll have to do it again. Yeah.
Yeah.
Well, we try and make these timely, right? And with topics that are relevant to everybody today. Marcos is wondering, how do you know when you are too conservative on your different projections and data from numerous sources? And this is an interesting internal topic as well. So do you mind opining?
Yeah, excellent question, Marcos. Too conservative. Well, it comes from your relationships with brokers and with other vendors in that market. And what I do is, I'm constantly calling other brokers, seeing where the market is in their eyes, and what their other buyers are doing and how they're underwriting the deals. What are they using for rent growth? What are they using for, their exit cap? Trying to collect a lot of that data as to what your competition is doing when you're underwriting these deals, because obviously you don't want to be too conservative to not win the deal. You gotta get to a point where you might get pretty aggressive on a deal, but like that's when you truly believe in the value of the deal and where it's going to go. And so it comes down to, I think, building the relationships, knowing your markets very well, and what you can get aggressive on.
Yeah, no, great answer. Ben's wondering now, are you able to ask the seller or the broker for tenant background info that the current owner used to evaluate each tenant?
Yeah. So you can pretty much ask any question you want to a broker. It depends on like what information is available and what the seller is willing to give to you. So, but like if you are seeing some potential red flags of the property in your underwriting, and it is a concern to you, definitely bring it up. Express the concern to the broker. Let them know why you're asking for that information, and they may provide it to you. They may not be able to provide you all the background information on all the tenants, but a good property management company should know who their tenant demographics are, and then even know who the property management company is. Do a background check on that property management company. Are they ones that always follow the rules? Are they breaking the rules? Get to know them a little bit more, and then that will tell you more about how they're managing that property.
Yeah, great. Kenton's wondering, do you dig into the current loan specifics in addition to maturity date, floating rate prepayment penalties, yield maintenance assumption, cost, late payment, all that kind of stuff?
Absolutely. Yeah. So like when you're looking at a property that has an assumable loan, you want to ask for the loan financials and the documents. You want to know, as far as if it is a floating rate, when is it maturing? Is there a cap? Do you have to set aside money to buy another rate cap? And then you want to make sure that you know what you're getting into, because is it recourse or non-recourse? Is that something that you're willing to accept? So those are definitely some items that are to be provided by a broker, and most of them will definitely provide that information, especially if it is an assumable.
Yeah, no, excellent. Cash is wondering if depreciating rent is a red flag.
Depreciating rent as a red flag. not sure I really understand his question. If he can,
Well, I think he means if rents are trending down instead of up. I'm pretty sure that's what he's going
oh,
for.
okay.
Yeah.
If that's the case, it is a red flag. If it is trending down, rents are trending down. But then, yeah, you want to know why. Is it poor property management? Is it the actual market? Are there other properties in the area that are brand new that are attracting the tenants, so you're dropping your rents to be competitive? Lots of questions to definitely ask. So,
Yeah.
yeah, it is a red flag.
Yeah, excellent. Mark's wondering, do you usually build in different scenarios, like worst case, best case,
Mm.
and all that kind of stuff?
That's right. Yeah, we do. We build a base case model. So we put in our basic underwriting assumptions. What our expected rent growth is on a property, and then we basically set that in stone. And then we can look at doing creative things with the property, or different business plans. So are you able to project a higher rent growth if you put more class finishes in a unit in your renovations? But you could definitely do that. And we also have a best case, worst case scenario. Excel actually does this really cool feature in there that gives you a best case, worst case kind of range function that you could play with, and give it some different parameters that might change, like as far as like rents or expenses increases. So, but yeah, we always have a base case, and then do comparisons as to what might be more beneficial to the property.
Yeah, and I always say, once you have your beautiful model all figured out, you just try and break it in as many ways as possible,
Yeah.
and that'll kind of show you the weaknesses in your underwriting. Eric's wondering, how do we determine an exit cap rate? Maybe you can go into some things that we do in our underwriting, and how we handle that.
Yeah. So that is the $1 million question, and the always the crystal ball question. How do you determine your exit cap? So exit cap is a projection based on how you feel that market is going to perform in the next 4 to 5 years. And so what traditionally has been done, as you look at the current in place market cap and you increase it 5 to 10 basis points for every year that you hold the property. Well, that was pretty common and true for up until recently. And there's been such a market shift with rising interest rates, higher expenses such as insurance costs and taxes, that are all affecting your value of a property, which has a relationship with your cap rate. And so, you could go still the traditional route of assuming 5 to 10 basis points per year for your exit cap. But it's also knowing your market and what's happening, and making the prediction within your own organization. So every property that we underwrite and submit an offer on, it's always the same debate. What's our exit cap? Why is it this? Well, this is how we feel. This is, where we see, you could look at projections from CoStar and see where their projected exit cap is going to be, or their cap rate is going to be in several years. They don't have a crystal ball either. That's their projection. But what is really important is analyzing the property and applying a business plan that you can achieve on. The exit cap is just gravy on the cake. If you can underwrite a property and it's cash flowing and you can perform on your business plan, execute on that. Your exit cap, you have no control over it. You can project where it's going to be, and And if you hit it bang on in 5 years, amazing. But and you're always adjusting your sales as well, and understanding where the market is going too. And if you need to sell, if you see an opportunity to sell, in year 3 when cap rates are compressed, do it. If not, survive until the next, as they say right now, survive till 25. When cap rates come back down. So hopefully that answers the question.
Yeah, no, that was great. Karen's wondering how AI can help us underwrite properties. AI is a
Yes.
pretty hot topic.
Yes. That is a great question. And I'm actually investigating all that myself too. There is a company that's out there that they don't necessarily analyze the properties yet, but they help you analyze the leases, the contracts, and it's you pump out 200 leases in like 3 minutes, and we'll give you a summary on it all. And that's what AI is helping with. And I just forgot the name of that company. I'll look it up here in a second. So that's one company. Red IQ is another company. They've created an underwriting program platform. And the last time I talked to them, they've been working on AI integrations, and it helped them with basically market analysis and property analysis. So it is evolving right now, and it certainly can help. It's something that I'm intimately paying attention to. I use AI all the time, and I think it's a great tool with great potential.
Yeah, awesome. Maybe just not OpenAI right now.
Yeah, OpenAI is going through a little bit of dynamics at the moment. So yeah.
Yeah. Cash is mentioning that you had brought up a couple of resources and sources for data. He's just wondering if there's any paid or free tools that give a consolidated view of the data.
Probably the best consolidated view of data would be CoStar, or RealPage. Both of those companies. Yardi is another company that does this. So they have the best paid versions. There are free versions out there, but then the information might be a little, outdated. So you're paying for the most up-to-date information with the paid subscription. So CoStar, RealPage, Yardi are probably the top ones that I'd recommend for you.
Yeah, for sure. Oh, Jasmine has a question here. So what are our stress test parameters other than interest rates and vacancies?
Oh man. Yeah, stress testing. We look at stress testing if we want to renovate all the units. Do we need to raise all the capital to renovate all the units? Stress testing as far as expenses, looking at if we're expecting insurance costs to go up, or taxes to go up as well. With all these with all these units that are being delivered in the market, that's going to increase our vacancies. You want to look at adding more concessions. What does adding more concessions do? What is increasing your marketing cost to attract more tenants? What is that going to do? And so you'll be able to kind of feel it out as to like what makes a significant impact and what has a very minor impact. But it just playing with it and seeing what kind of gives the best outcome for your business plan.
Yeah, that's awesome. And somebody wants to send you some free lunch in exchange for data, Paul. So
yeah, fair enough.
All right, no, that's awesome. I think that's it for Q&A. We actually had some really good questions tonight. So just a quick reminder, if you are interested in learning more about some passive investing opportunities, or if you're interested in possibly co-GPing with us on our next deal, just go to go.cpicapital.ca/call. And you can book a time on our calendar, and we are always happy to chat and share what we are up to. So Paul, thank you just one last quick question that just came in. So what do we project for annual increases for insurance and taxes?
Yeah. So for Florida, there is a cap as to what the assessor can reassess your property at each year as you own it, which the cap is at 10%. And then you can historically go back and look at what the increases have been year over year. And then consulting with tax attorney as well, that they'll be able to tell you specifically with that property what they feel that you might be able to achieve for escalation. And we, in the beginning, in our underwriting, our base assumption is 5% growth. 5% growth in the real estate taxes. Insurance, that's another wild ball right there. But we put 3% in our growth year over year for insurance. So insurance is 3%, taxes at 5%. And then consult with a tax attorney to see if we need to increase that or decrease that by any means.
Yeah, excellent. All right, awesome. And then Cash is still waiting for you to share your beard regimen and all that. So maybe we'll get you a sponsorship with some beard product or something.
There you go. Yeah,
and we can get you going.
Yeah, perfect.
That's awesome. Okay, well, we've wrapped up the Q&A. So Paul, again, thank you so much for the past hour. This has been awesome. So thanks for sharing your expertise with us.
Absolutely, my pleasure. And thanks. And have a happy Thanksgiving to everybody in the US.
Yeah, happy Thanksgiving. Eat lots of turkey. All right,
right.
Awesome. See you guys later on December 5th for the next free web class we have. And until then, happy investing, everyone.
Thank you. Bye-bye.